Now, what we're seeing at the moment is a cyclical downturn, a very sharp cyclical downturn. In many ways, that cyclical downturn is as big or bigger than we saw at the time of the 2008-9 global financial crisis, which is clearly a reason to be worried. Normally, in these periods of tight liquidity, you get some sort of financial disaster of some form, whether it's a Lehman moment or whatever. It's very difficult to predict ahead of time. And that's why we're cautious about the credit cycle looking forward 6 months. And that's why we fully expect central banks to come back and pivot, because liquidity is so important into the system. Okay, I think the easiest way to see this is to basically start to question what the financial system really does. And if you pick up a textbook, an economic textbook, what they're really saying is that the financial system is a new financing system. And that's how we understand it. So interest rates are important. In fact, that is now completely wrong in many ways. The financing system is really a refinancing system. And it's a refinancing system because there's huge amounts of debt out there. If you think of the debt load that the world economy has got, it's now something like $350 trillion. That debt has an average life of about 5 years, which means you've got 70 trillion of debt to refinance every year. And that's where liquidity becomes very important. It's not interest rates that matter in that context. It's the ability to get the roll on the debt. In other words, to refinance your positions. If you don't refinance your positions, you either default, or if you're a mortgagee, you're homeless. So it's absolutely critical. And traditional economic textbooks miss this refinancing element. Now, if you look at the new financing part of the economy, with a world economy of about $100 trillion, let's say a fifth of that is capex, about half of that is externally financed through capital markets, or about $10 trillion. So what we're really saying is the 70 of refinancing compares with the 10 of new financing. It's a 7-to-1 ratio. So the system is really about refinancing. Interest rates are less important. The volume of liquidity is key. If you get slowdowns in liquidity, the ability to refinance is challenged, and you get financial crises. Financial crises are not about failures to finance new capital. It's to finance existing debts. And that's why if you look back over the last 20 or 30 years, all the major financial crises that we've seen have basically been problems about refinancing, whether in the repo markets or the mortgage-backed security markets or wherever it may be.
Mike, you have an interesting background. You, of course, were head of research at ING. You have a PhD in economics. For folks who are listening to this and hear echoes of Hyman Minsky in the framework that you have for refinancing, give us a little bit of a sense of what those risks are. I know that Minsky talked about these different types of borrowers and this risk of the so-called Minsky moment. Tell us a little bit about some of that framework.
Yeah, I think there are certainly parallels. I mean, we come from maybe a more practical than a theoretical perspective, but it's really the experience of seeing indigestion in markets when you get these problems about refinancing. And that's why we put particular stress on the liquidity dimension and how global liquidity, which is a pool of about $170 trillion, which moves quickly around world markets, is critical to this funding equation. Central banks don't really seem to understand that dimension. Central banks are focused very much on interest rate setting, and they seem to lose sight of this liquidity fact. And if you listen to what central banks are doing right now, what they're trying to do is to reduce the amount of liquidity in markets. For example, the Fed's desire to shrink its balance sheet. If you listen to what Jay Powell is saying, he's talking about potentially a 30% drop in the size of the Federal Reserve balance sheet. On our measures, that's a drastic slump. And the fact is that liquidity will have a non-linear effect on financial markets. So in other words, if you have a small drop in the size of the Fed balance sheet, it may not matter very much. But if you get a progressively larger and larger drop, then that matters significantly for financial integrity. And we would estimate that if the Federal Reserve is talking of this magnitude, maybe a 25% drop in the size of the balance sheet from maybe 9 trillion to something like 6.5 or 7 trillion, what you're really thinking of there is the equivalent of maybe 4 to 5 percentage points additionally on Fed funds rate, not the 0.25% or 0.5% that the Fed glibly talks about. It's going to be much, much more important than that. This is a major squeeze in financing capacity.
Mike, as always, you've brought with you some charts that show visually what your framework is. Let's walk through those.
Mm-hmm. Okay, I think the first one to look at is what the Global Liquidity Index, which is one of the first charts that I sent over, is really telling us. And what that's illustrating is the gyrations, cyclical gyrations of liquidity. But basically, the liquidity index that we calculate is now in free fall. So it's dropped from very high readings. The index we scale between 0 and 100 has dropped from levels of about 80, so very loose liquidity, to latest values as of the end of July of barely 20. So there's been a dramatic falling off in liquidity. Now, why does that matter? It matters because if you look at the growth rate of global liquidity, it has had an unparalleled correlation between that and asset prices worldwide. And there's a subsequent slide which basically shows that correlation. Now, one of the things that we indicate on that slide is the projection of global liquidity growth into 2023 and beyond. And that expectation or projection of growth is based on what central banks are telling us they are going to do with QT. This is gleaned from what the Federal Reserve has pronounced in terms of its runoff of Treasury holdings. It's what the ECB implicitly have been saying about what their balance sheet will do as the previous support unwinds following the COVID emergency, and also what other big central banks like the People's Bank of China is slated to do. And if you look at that, the picture for liquidity is ghastly. It looks really bad. If you follow the letter of that projection, there will be financial dislocations in markets over the next 12 months. I don't believe that central banks will be able to do that because I think they'll have to reverse out. And that's why I think there'll be a pivot coming at some stage in early 2023. That pivot may not involve a cut in interest rates, but it will probably mean that the Federal Reserve at least sits on its hands for some time and digests maybe some of the damage that's being done here. So that picture is clear. One of the things that we ought not to be misled by is actually looking too closely and inferring too much about sort of very short-term Federal Reserve operations. One of the things you'll see in, I think it's a third chart that we show there, which looks at the Federal Reserve liquidity injections and the movements of the S&P 500 or the SPX index. What that shows is a very neat correlation between those two factors running back from 2019 onwards. And the correlation is remarkably tight, and it actually tightens significantly over the last few months. So the Federal Reserve has actually cut the effective size of its balance sheet already through other means, not by rolling off treasuries, but by the big uptake in reverse repos, which is a slightly wonkish concept, but it's basically the Federal Reserve selling own name bills back into the private sector, and also the rise in the Treasury General Account, which is a float that the Treasury keeps at the Federal Reserve. Those factors together have probably taken about $1 trillion out of the balance sheet, and they explain a large part of the slump in the market indexes so far this year. The interesting point is that the Fed appears to have flatlined in the last couple of months. There's no real impetus to that liquidity takeoff. And many people have inferred, I think wrongly, that QT has halted and the Federal Reserve is doing a stealth QE back again. I don't think that's correct. I think that there are technical factors that are buzzing around that are really stopping the Federal Reserve engaging the gears of QT quickly.
Mike, one of the interesting things about your work is that you tie the macroeconomic to the capital markets. What are the implications as you see them right now for different asset classes based on the view that you have from global liquidity?
Okay, I think the first thing is to look at some sort of template about how markets are moving. And one of the things that we show is a chart that looks, if you like, at the standard bear market behavior of the S&P. So what it looks at is a chart which shows the average movement of the S&P in a bear market. This is data which goes all the way back to 1970. We've indexed it so you get a sort of a standard run of what the market would look like. There's a sharp V as the market collapses and then a rebound on the other side. On that same chart, we plot liquidity, US liquidity in this case, with the red line. And what that shows is how liquidity leads the market and the sort of things that one can expect coming out of that. Now, generally speaking, and this is the thing to think of, and bear in mind, of course, that this is an average, every cycle is different, but this is the average look. What it shows is the market typically falls by about 25% in the first move down. That is when investors start to reassess growth in the economy, and it's largely because of central bank tightening. So in other words, it's when PE multiples start to collapse, and that's the phase that we've been in. Now, one of the things that you'll see from the chart is, interestingly enough, there's always an another up leg. In other words, that the market goes down 25%, it rebounds. That rebound has tended to average about 10%. It's lasted about 2 to 3 months on average. And then you get another leg down, a second leg down, which is based much more on a traditional credit cycle or earnings cycle, when the economy is weakening and earnings numbers are being slashed. And that fall is normally of the magnitude of about 15 and 20%. Now, that tends to mark the low in the market. Coincident with that, liquidity conditions tend to spike up significantly. And it's around that low point that the Federal Reserve is on maximum warp for ease. Okay, we haven't reached that stage yet. We're still in the rebound phase. And that rebound phase may have gone a tad further than the average, but you get the idea that this is the normal sort of sawtooth pattern on the market. On the other side of the bear, what you see are dramatic increases in the indexes when liquidity goes in. The first leg up is about 25 to 30%, and then you get a subsequent 15% or so rise after a small pause. But this is fundamentally driven by liquidity. So that's really the steer that we're getting. And that's what we would suggest investors look at closely.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.